All right, let's get in the trenches here with dividend stocks. Now, Scott, I wanted to talk about this area because I feel like they've had big moves for the year. A lot of investors have already been in these stocks, but still they're not really going down that much, and they're really providing a safe place for investors to put their money because they provide really nice dividends.
Right.
And in particular, if you look at J&J, from Q2 to the present, it's up almost 12%, but we just got an upgrade or initiated a new market perform at Morgan Keegan. I mean, like, this is catching on more steam. We can't seem to get rid of these guys.
Well, I haven't really been trading them, but when you give me the list to look at, I start to see some good-looking charts. And good-looking charts...
Which is surprising to me, actually, because they've had so much popularity.
So that means that they're under accumulation, and they've been holding up in this downdraft, which is good. For a trade, it'll be interesting to see if we can get some momentum, not just a slow appreciation, which usually happens in dividend stocks. But I see some spots here. If you look at J&J, look how, you say these things aren't exciting sometimes, but from 62 to 66 and change, it went pretty quick. This was a great trade for even traders. And now, look how it's going sideways. Nice consolidation, absorbing this big move. It's actually above the 50-day moving average where the markets are at the 200-day.
Right.
That's showing relative strength. I do think that this could be one of the first to break out. Traders will probably even get involved if this thing can get above 67, 67 and a quarter for some momentum. So it's been a good investment. And now it seems as though it can get some momentum, and above 67 is that area for J&J.
Does it still make a good investment? I mean, after all, it has almost a 3.5% dividend.
Yeah, because if you're getting a dividend
Right.
and it looks like it can appreciate, you're getting a lot more bang for the buck, which we always love around here.
We do. And I also wanted to go to McDonald's because what's interesting here is as we see oil prices come down, generally the consumer staple stocks will also get better margins. And they've been dealing with, $110 oil for a few months and sort of dealing with their cost cutting and dealing with that. So if that changes and if oil goes down, this will be a catalyst for these guys, especially McDonald's. But it's at 52-week highs. So how do you rationalize?
I love stocks at 52-week highs because that's where the momentum is, because no one who believed it needs to cover when it makes new 52-week highs. And I also haven't been really looking at McDonald's. And when I saw this chart, I was pretty surprised. This stock is right back to the highs. This was your more macro entry right around here when it broke above this pivot, gave you a nice move, retested, and now we're back near these highs. If we can go sideways a little bit, there could be a nice juicy trade above 83, and then maybe into that excitement, that's where investors should take a little bit off. But that could get some follow-through if this market continues to bounce.
And I wanted to compare real quick Pepsi and Coke, since, they're usually the two cousins of the group, I guess.
I like Diet Pepsi.
Do you? I don't drink soda, but if I did, it would be Diet Coke. All right, so we have Pepsi is up, is up about 6% from the second quarter to the present, but Coke is actually down about 2%. So I wanted to kind of see, they both offer almost a 3% dividend, so I wanted to see which one made the better investment and the better trade.
Well, real quickly, I looked at both. Coke, I don't really like this pattern here. It's a little sloppy down here, but it is above the 200-day. I do want to show you Pepsi, which I think has a better chart pattern right now because this was your macro entry when it cleared the prior resistance. You had a nice move to highs. It's had a controlled pullback above the 200-day, showing relative strength. Nice tight pattern, so if you're not in there, you get to see your nice entry above 69.50-ish. I think it could go again. So above 69.50, that's your spot for a trade for Pepsi, and right around here, could be a tier 1 considering that this is a value play with a yield.
And also Pepsi has a lot of junk food, which will definitely benefit from lower oil prices in terms of input costs.